Okay, this is lesson number 7, and here we are going to look at profitability. So I'm just looking for a pen. Actually, at some stage I'll have to show you around the room, and just to show you where I'm working from. I'm working from a shed, and the sun has just suddenly come out. It's winter time now, and it does get pretty cold at times. Anyway, number 7, profitability. Now what I've done here is I've actually got a Unit 3 paper to show profitability, but I'm then going to go back to Unit 2 paper and also show some examples of how profitability can also work. Now, if you can remember profitability, there are 3 ratios that we need to learn. The net profit margin, which is net profit divided by sales revenue times 100, the gross profit margin, which is gross profit divided by sales times 100, and the return on capital employed, which is net profit divided by capital invested times 100. So they are all percentages. And remember, I'm always going on about you must have a very, very clear understanding of profit. So it's sales revenue minus variable costs, gross profit minus fixed costs is equal to profit. That's one way of looking at it. If you go all the way back to Unit 1, it's also called total revenue minus total costs is equal to profit, and total costs are made up of variable costs and fixed costs. They all actually mean exactly the same thing. Okay, so if we got in here, we got an income statement on here, which reminds me actually, I might on the next lesson just very quickly just show you all of that. Anyway, we got an income statement on here, and this firm is turning over 295 million quid. The cost of sales 137 million pounds. It's got the gross profit 158 million and the net profit of 16 million. Now we can look at that quite quickly and say, well, they've got quite a high turnover, but they're not making a lot of profit, but they are making some profit. So that's a good thing. On here we have a balance sheet. Now, don't worry too much about this at this moment in time, but basically this firm has invested 780 million quid. Now, I can get that information from a balance sheet, and I've just shown a part of it here. And non-current liabilities means that this company has got 280 million pounds worth of loans, and the shareholder funds come to 500 million pounds. So if I add those two together, really 780 million pounds has been invested into that business, and then we can get a return on capital employed from there. So to work out the 3 profitability ratios, we just go 16 million divided by the sales revenue 295, and if we do that, 16 divided by 295, that comes out as 5.4%. Quite a low net profit margin really. If we do the gross profit margin, then that's 158 million divided by 295 million, 158 divided by 295 times 100 is equal to 53.5%. What does that mean? Well, that means this is actually a clothing firm, is that they're making over 50% on each garment that they sell in terms of their direct costs. So they're adding quite a lot of value to that product. So that would suggest they've got a reasonably good product where they can probably charge quite high prices. Perhaps it's got a low price elasticity of demand. We've got all the concepts there of adding value and everything else. The return on capital employed is 16 million divided by 780 million quid, which is 2.05%, which is not good. You would get 3% from a bank with no risk at all. So we can say, well, okay, this business at this moment in time has got a product that's got a high value added. Its net profit is quite low, although it is making money. Maybe its fixed costs are too high because it seems to be making a lot of money in terms of its gross profit. So maybe we can cut down the workforce or something like that. The return on capital employed, which is 2.5%, which is the big one, the most important ratio, would suggest that this firm is not doing particularly well in terms of the amount of money invested, and maybe it needs to change direction. So once again, very, very quickly, I can summarize all of that. So it shouldn't take me too long to work out these 3 things on here. And from that, without even looking at the case study, I've got a pretty good idea of how well that business is doing. Thank you. So this is number 7, and I just said earlier on in the previous episode that what I would try and do is I would try and give you the different areas, different ways in which you can work out profit on the different units. The different ways. profit is always exactly the same, except on unit 1 they called it total revenue minus total costs. So we could have total revenue here minus the total costs here is equal to profit. Fine. The total costs will be made up of total variable costs and also fixed costs on there, and then that will give us the profit on there. Okay, I'll give you a working example of this in a second or two. Income for unit 2, or what I sometimes call it profit, will be sales revenue minus variable costs, again, is equal to gross profit. And the reason why I like you to sort of learn all of these is because without this one, you can't work out the gross profit margin, obviously. Minus the fixed cost is equal to net profit. So once again, if we can get the net profit margin from here, which is on there, and also we've got net profit down here, then we can also obviously work out return on capital employed, which is net profit divided by capital invested. Now they often use this in the passage because they might say, okay, this business is making £500,000, we may have worked it out here, and then £4 million has been invested in machinery, so you can go 0.5 million divided by 4 million, and that is equal to 12.5%. So that's what profit is all about. And remember, of course, there are 4 ways of increasing profit. We can reduce variable costs, we can reduce fixed costs, we can try and increase the sales revenue, and finally the third one is maybe if you've got an inelastic demand, maybe it's not a bad idea to increase the price, and that will also increase your total revenue, and actually will also reduce your variable costs because you're buying fewer products, and that will also improve profitability. So you must sort of have this in your head at all times. Thank you. So I'm also doing profit on this one on here once again. Remember, income unit 1 is total revenue minus total cost equals to profit, or total revenue minus total variable cost minus fixed cost is also equal to profit. Okay, so in this particular equation here, I've got selling price, very easy one. Selling price 10 quid, variable cost 5 quid, fixed costs are 20,000 quid, and the output is 10,000. Now, okay, so I'm making all this nice and easy. What they tend to do on unit 1 is they tend to mix the numbers all over the place, and what happens if variable costs go up by 10% or something like that. But okay, just teach you the basic principle here. There are 3 things we can work out from this information straight away. We can work out the break-even point, which is equal to fixed cost divided by contribution, remember. Total contribution. Now, this is not something that I've done this course so far, but the individual contribution here is obviously 5 quid. And if we sell 10,000 of them, then 5 times 10,000 is equal to 50,000 quid. So that is the total contribution. We can also work out the profit. Okay. Now, the reason why I'm just going to show you 2 different ways in which we can work out profit here. They both mean the same thing and they both come up with the same answer. I'm just going to show you that in a second or two. Okay, so we work out the break-even point. We go 20,000 quid, 20,000 up there, divided by 5, because it's 10 minus 5, that's the contribution. 10 minus 5 is 5. 20,000 divided by 5 is equal to £4,000. To get the total contribution, I'll go 10,000 times 5 quid. 10,000 times 5 quid is 50,000 quid. Okay, so sometimes they ask that on unit 1, can you work out the total contribution, please? Which is pretty easy now. So yeah, that's it. And then you've got 50,000 minus the 20,000, which is the fixed cost, and that gives you a profit of £30,000. So once you've worked out the total contribution, if you take off the fixed cost, that will give you profit. Why is that? Because what we're really doing is, when we work out the individual contribution, we are taking into account the variable costs, and if we multiply the contribution therefore by the quantity, it's almost getting us down to the gross profit area, and if we subtract the fixed cost from that, that will also give us profit. To work out the profit in the normal conventional manner, I will do 10,000 times 10 is 100,000 quid, 10,000 times 5 is 50,000 quid, the fixed cost of 20,000 quid, so therefore the profit is 30,000 quid on there. Okay? Now obviously when we move on to unit 2, all I'm doing is I'm also shoving in gross profit, and I call that net profit. All right, and then that will help us to get gross profit margin, net profit margin, and also if we know how much money has been invested in that business, we can also get return on capital employed. Thank you. Okay, so this is the last section on profit, and I'm just moving on to a question on here And there's not a lot of profit information here, but there is some that we can utilize and use in terms of the question. So once again here, they give you a whole series of data, including the title, which is all day moving into a niche. That means it's moving to a niche market. That means it will probably be able to charge higher prices and have a lower price elasticity of demand. And so it's probably moving from a mass market into a niche market there. Now the number of stores has gone down, okay, so maybe they sold some stores. By selling some stores they can raise money, so it's less likely to be a cash flow problem. The sales revenue has also gone down, but we would expect the sales revenue to go down, and I suppose looking at it right now we could do a calculation. We could do 40 into 10 million, which I think is £250,000 per store. Whereas if I do 13.4 million divided by 15.8, 13.4 divided by 58, that is equal to 231,000. So the sales revenue per store has in fact gone up. That's a good thing. But also probably the most important line is that the profit margin was falling. Now that would suggest therefore that their old strategy wasn't working as well. So then they moved on to this new strategy, which will be the niche market, and they're now getting an 8.8% return. Okay, the sales revenue is smaller, right? So what we could do is we could do 8.8% of 10 million, which happens to come to 0.88 million. So that will be their net profit. And we could do 3.4% of 13.89 million. And if you do that, you calculate it out, that comes out as 0.47 million. So you've also got to be pretty good at working out percentages and everything else. So just from a purely profit point of view, we can definitely see that the firm was doing badly. So therefore it would have been a good move to move into the niche market. And now the firm is doing much better and it's getting a much higher rate of a much higher net profit margin. And it's also making higher profits. Now there is other information on here which I'm going to leave on here, because when I do the HRM bit, then you can see how it starts to fit in with that as well. Okay, so all day moving into a niche, just a very small amount of information in terms of net profit margins, and we can react to that data and come up with an analysis of that business.